you for coming. Just for our participants' sake and for mine too, I'm going to do a show of hands. How many of you are University of Florida MSF seniors? You're graduating this year from the MSF program. Okay, and how about MSF juniors? About 13. And prospective students, like undergrads looking to maybe apply in the future to the MSF program, hi, I'm proud. And MBA students? Okay, and MSRE? Real estate? All right. Did I miss anybody? No, okay. Accounting? All right. Thanks.
Welcome back, everybody. Today we have been a busy day, so I have to remember where I am. So we have Robert Klein from Evercore, and he's a graduate of the University of Florida, as most everyone is that participates in this program, and got a MBA from Columbia, and has a background in real estate, and he's going to talk a little bit about that himself to sort of set the tone of what he's going to do. And as always, he's encouraged me to encourage you to ask questions at all times about something that's interesting. He certainly wants to walk away answering the questions that you're interested in knowing, as opposed to what he might want to talk about or what he has planned to talk about. So, Robert, thank you very much for coming.
All right, so I'm happy to be back. Since I graduated in 1997. School looks very different. Burrito Brothers is no longer where I remembered it to be, but I'm sure I'll get acquainted shortly here. So I think the things that I'd like to talk about today, and by the way, I don't want to just talk. I prefer if whenever you have questions, whenever you want to talk about something, just raise your hand, interrupt me. I prefer not to preach to the crowd for an hour and a half. I prefer it to be totally interactive. We could stop anywhere during the presentation or talk about anything that's not on the presentation. So that's the way I'd like to run it. I don't want anyone to be shy about that. But the things I kind of put on the board to talk about today to kind of stoke the conversation were first my background, then we'll talk a little bit about Evercore partners so you guys get a flavor for where I work. We'll talk about my group at Evercore. And finally, we'll talk about the public real estate market. So, as a way of background, I was at the University of Florida from '93 to '97. So I had the benefit of seeing the first national championship here, which was fantastic. Upon my graduation, this program didn't exist, so my career path was a little bit different, and than probably what you guys are going to go through. My training was probably far inferior to what you guys are going through as well. So I had a little bit of a tougher road getting a job. But what I did was when I came back to New York, where I was from, I worked at a company called Bankers Trust, who subsequently was purchased by Deutsche Bank. I took a job there, and it was really the only job I could get at the time. And it was a back office job in Jersey City, across the water from Manhattan. And I was doing stuff that nobody wants to know about in Wall Street. Things that happen after a trade's made and everyone assumes it gets done. That's what I was doing, getting it from there to actually completion. From there, I made my way into Goldman Sachs and worked in fixed income derivatives group, which was a great job, very cutting edge. It was when swaps were first being done. I don't know if everyone's familiar with what swaps are, but it basically was converting cash flows from kind of a floating rate to a fixed rate, and then it evolved into being a hedge for all sorts of financial instruments. From there, I moved to the private wealth management group in Goldman Sachs, moved to Los Angeles, and we were managing, I think, circa $3 billion. We were a group of maybe 7 or 8 folks, and I kind of ran the fixed income portfolio for our group. Another great, exciting job, and after that, I went back to business school, was at Columbia for a few years, and it's kind of where I learned about my interest in real estate. I had a background, obviously, in finance and had worked at financial institutions, but I attached to any of the products I was working with, whether it was the fixing of derivatives or it was other people's money. Never really got excited about it all, and so I was trying to figure out what kind of product could I get my arms around, show other people, see it all the time, but yet also have the financial component to it. And that's kind of where real estate came in. So I did a lot of investigating in business school and ended up with a summer internship at Rexon. Rexon at the time was a $4 billion REIT. We owned, operated, managed, developed, did construction, everything for mainly office buildings in the tri-state area. And the tri-state area for me was New York, New Jersey, Connecticut. It was mostly suburban office. We had about 5 or 6 buildings in Manhattan as well. We grew from the time I had my summer internship to the time I started working there full time, and then eventually left there. We grew from $4 to $6 billion company. When we were at the height of our market cap, we had a merger with SL Green. SL Green is another large office REIT, much more urban than suburban. They bought the $4 billion side of Rexon, which was Manhattan office, and then other things they called CBD assets, which were the Central Business District assets. It was in White Plains, it was in Stanford, it was in areas that felt more like the city than it felt like the suburbs. During that process, I reached back to my school in Columbia and said, look, we're going through a merger at this company. I'd like to do something else. I don't think I want to sit around and wait for the merger to complete and figure out what's going to happen. And I'm too type A. I can't just sit around without activity. What should I do? They partnered me up with a gentleman named Marty Chico. Marty Chico was and is kind of world-renowned in real estate banking. He was vice chairman of global real estate at Merrill Lynch. Merrill Lynch had a phenomenal market share in real estate banking at the time. He was there for 30 years, and anyone that's involved in real estate and banking knows who he is. Had an opportunity to, when he retired, he was starting a new shop, had an opportunity to go work with him pretty much one-on-one with another company, with another individual, and did that for a few years. We did, we were a boutique as it gets, 3-man shop, doing real estate banking. Realized that works, that's exciting, that's fun, but there's a lot of deals that you need other sides of the house to do, whether it's restructuring, whether it's something that dabbles in real estate and other industry, which we'll talk about as we kind of go through the presentation a little bit. And so we explored with a few other companies who should we merge with so we could get the full benefit of the entire infrastructure of an investment bank. We sold our business to Evercore, and this was last year, around April, and I think it was in June or July, and so we've been there since. So is there any part of that anyone wants to chat about more that I kind of didn't talk about? No, I'm sorry.
Can I fix your microphone?
Sure. No, that's fine. Just clear.
Awesome. Is that better?
Yeah.
Okay. So if there's any of that anyone wants to come back to, let me know. So a little bit about Evercore. At this point, we're greater, I think, than 800 employees. We've grown substantially over the past few years. There's been quite a large fallout on Wall Street in terms of senior professionals looking to leave the bulge bracket firms and enter into more of what we call the boutique world, doing more unconflicted, straight-up advisory work without any of the balance sheet type of activity that a lot of bankers do. So we've grown. We've got 67 senior managing directors. We're all over the globe, U.S., Europe, Latin America, and Asia. And we do a breadth of advisory work, everything from M&A to IPO advisory. We do secondary issuances. We're doing debt capital markets and restructuring. And then we've got about $17 billion under management in our asset management or investment management division. And that's grown substantially over the past few years. And ultimately, the goal is for the firm to increase its percentage of revenue that comes from investment management so it smooths out the lumpiness in the advisory side of the world. Because as most people know, M&A and restructuring business is very lumpy. There are years where tremendous volume, there are years where there's lower volume. Hopefully those two businesses hedge each other a little bit. But investment management is a fee-based business. And so
one fund, or you have fixed income equity and stuff like that? What is that?
we've got quite a few product types, but a majority of it, I wonder if it's on here actually. We'll get to it, I guess. We purchased a company that had about $10 billion under management. They have various different product types. I think it's fixed income and other equity securities. But this is strictly management fee type of business. And we also own a portion of Trilantic, which is a private equity shop. And how we grow from here, and if it will be more on the fixed income side or the equity side or the private equity side, I'm not really sure. But I know that we're always entertaining, what's the next way to grow this? And is it organically, or is it by owning positions in other companies and keeping those employees still incentivized to grow their assets under management? This gives you a little flavor for how Evercore is set up globally. We have affiliates or subsidiaries across the world, from Mexico, Brazil, Argentina, to China, South Korea, London, Japan. And my group's been fortunate enough to work with, I think, almost all of those subsidiaries or partners. It's very well integrated. There's quite an open line of communication between them, whether they're wholly owned or just partners with us on deals, on cross-border deals. So it's fairly fluid as to how we operate across the globe. These are the various industry verticals, and what I find particularly interesting here is, real estate is its own animal, its own language, and we'll talk a little bit more about this later on. And so you wouldn't think, well, real estate's never going to do a deal with media. So why does that help you and your group, Rob, being at Evercore? And actually, we've touched probably 5 or 6 of these different groups. With the media group, we've talked about some online real estate providing services together. With the telecom group, we've talked about how some tower companies can become REITs. We've looked at a couple of parking deals with the transportation and infrastructure group. And then I think we've touched a few of the other groups as well over time. This is the standard league table stuff. I'm sure anyone that comes in here from any bank is going to show you this, and they'll either be number 1 or 2 on at least one of the charts, depending on how you cut it. It's part of the talent any of you will learn when you become an analyst as to how to cut what you did to make it look like you are the best as well. But some of this is really not cutting when you look at it. In terms of the boutique world, we've been pretty much historically at the top of that in terms of the kinds of deals, the size of deals, and the frequency of deals we work on, both this year and over the past 11 years. And then when you compare us to some of the larger banks, we still kind of compare favorably. This year alone, we're kind of hanging around with some of the bigger names that you probably recognize. Yet we have maybe 1/10 of the staff. So you have to kind of keep that in perspective. It's truly a boutique kind of firm. Yeah. I think this one does. Yeah, which is questionable at the moment. But there are some deals on there that we're going to do that aren't on as well. It's one of those things that, like, at any moment this table changes and we find someone that can get us near the top again. And there's your T-Mobile. So these are just a sampling of the kinds of deals we've worked with over the past few years across the firm. We tend to have a fairly high hit ratio in terms of how much we pitch versus how much is kind of live deal. And Alex can probably speak to that a little bit as to what he saw over the summer in terms of how much of it was prospective versus live kind of deals and his colleagues. But that tends to be the case, that because we're smaller staff, we try to be a little bit more efficient and go for higher hit ratio type of business.
I guess if you have a high hit rate, you must either have a relationship or serious expertise in that space. Is that how you, obviously you must be the go-to with certain kinds of transactions, is that fair to say?
Absolutely, yeah. I mean, there's There's one thing that kind of Evercore takes pride on, and that's the concept of giving unconflicted, independent advisory advice. And so we can truly say that because we don't use a balance sheet, and therefore, our clients that are some of these larger clients, these better relationships we've had for a long time, even if they're going to hire another bank at the same time, they're generally looking for someone that can give that type of advice, because when someone's also loaning to you or doing something on the capital market side, there's always a little bit of tension, especially when they have other sides of the house that might be lenders on the other side of a deal or have some other interest somewhere. So that's kind of how we compete on that stuff, and yeah, we'll be brought in when a deal is being thought of, and also when we're thinking about deals that should happen. And that's kind of how we control a little bit as to how much we're just pitching versus how much is a pitch that's targeted towards something that we think is realistic to happen. Firm was started by Roger Altman. Roger Altman did a few different stints in the Treasury, and he worked with Ralph Schlosstein. Always have a hard time saying that name. He was at BlackRock, started BlackRock, and then he became the president of our firm and was tasked with not only running our firm, but also trying to beef up the investment management side, given his amazing experience at BlackRock doing so. This gives you a little bit of a flavor for how our firm has been growing. It's pretty significant. It's pretty substantial. And each one of the senior SMD is the senior MDs, and that's our equivalent of a partner. Each one of those partners was either the head of a group at a big firm, the head of banking at a firm, the head of M&A. They all have these incredibly impressive resumes that have come to our firm. And some of it's been the fallout from the larger banks where they don't want to be doing things that are not straight up advisory work. And when you're at a bulge bracket firm, there's a whole set of tools that you have and a lot of different products you're working with. And a lot of these folks said, you know what, I'd prefer just to be doing straight up advisory work and not dealing with any of the other products. And so that's how a lot of this growth has been happening, and that's who the folks are that are coming to our firm at the senior level. This is at the entire firm, kind of what the growth looks like, and the 222 does not include Alex yet, that number there. This is what I was talking about with the assets under management. Right around Q1, Q2 of 2010 is where we acquired a company called Adaletta Sasnoff, and they had about $10 billion under management. And then we bought a stake in a company called Trilantic, which used to be at Lehman Brothers.
You looked at this last time, and I noticed you had the basically same amount of private equity throughout this entire chart, and I was wondering what the intention was with that.
On this side, which
yeah, on the next two slides forward. Yeah. Basically, almost exactly the same amount of private equity. And I was just wondering, is that because that's not something you all are trying to work with right now, or I was just wondering why that's a small portion. It's always stayed a small portion.
Mm-hmm. I think we're always actively looking for recurring revenue source type of businesses, and I think the opportunity's been outside of that at the moment, but we're always looking. So I think it's just a function of where the opportunity's been in the market over the past few years. I don't think it's a function of we don't want to be part of that.
Evercore just recently finished acquiring Mexican partners. Mm-hmm. So for the growth aspect, is it trying to grow organically or looking for more acquisitions?
We do a little bit of both. I think it's historically been more of the acquisitions and employees from elsewhere. That's because to get more employees, you can't do that organically, right? You need to take them from somewhere. But in terms of the global expansion, how we get our business globally, yeah, we're not generally bringing a U.S. team to create a Chinese office. We're generally saying, okay, who is one of the best independent Chinese advisory firms? How do we partner with them? Is it better to own a piece of them or to have some kind of strategic cross-border alliance with them? That's typically how we've been increasing our exposure that way. This is just the growing the investment management business, which we talked about. On the left is the company Atalanta Saznoff that I was talking about. They had about $11 billion under management, and that's where that huge growth in that chart came from with our assets under management. Anything else wants to talk about Evercore? No? All right. Let's start talking about me now. So this is some of the stuff that we do, the real estate group within Evercore. And as I kind of said, the way Evercore is set up is we have industry verticals within the M&A side of the business, and then the other side of our advisory business is restructuring and debt capital markets. But we do kind of work hand in hand. So when we do a restructuring deal, generally there's a product group involved. So we worked on a deal which we'll talk about in a little while called Centro, which is a real estate restructuring, and the team was half real estate, and the other half was from our restructuring side. Two very different disciplines. There is some cross-pollination of employees that kind of hop back and forth, but generally fairly distinct skill sets between the two sides of the house. We'll do everything in the real estate group that most of the other M&A advisory groups will do, from M&A to looking at any strategic alternatives to advising private equity shops, roll-ups, spin-offs, joint ventures, fairness opinions, the works. Anything you can think of that's in banking, generally we'll do it as long as it doesn't entail us using a balance sheet. We've done business across the globe, and we've got a fairly well-rounded and experienced senior team in our group, but we're small. These are just some kind of deals we've worked on recently, and you can see they range. They're across the board. We're currently working with Westfield on the potential sale of some of their non-core regional mall assets. We're advising a company that's based out of Brazil that's looking to develop shopping centers and a capital raise. That's our capacity. UDR is a company we've had a relationship with for a long time. They're an apartment REIT. They own multifamily type of assets across the U.S. They've been narrowing their focus to try to be more on the coast and the higher growth markets. And they did a big follow-on offering. And so they brought us in to, I'll get you in one sec. They brought us in to help figure out, well, how's the market going to receive this? Here's what we need to do. Here's our capital needs. What should we do? And so we went through with them their alternatives, how they should raise the capital, how much we think the market could handle, what they should be telling the market, and what they actually should be using it for, and what is and isn't going to be well received. So that was kind of our role on that deal.
For the shopping centers in Brazil that you mentioned, I know that you have an office in Argentina and I think also in Mexico.
And Brazil.
And Brazil. So does that work? Is that funneled specifically through that office, or is it funneled through your office and you kind of just work with them on the deal? To what degree is the expertise of your office in New York being the kind of the Flagstaff one help the Brazil office, or just do the work exclusively? How does that work?
So on this deal in particular, the relationship was with the developer on the private wealth management side of our business through Brazil. And through that relationship where they managed this guy's personal money, he had said, do you have a real estate group anywhere that could help us try to raise capital? And G5 is the name of our group that's based out of Brazil. They said, sure we do. We've got one of the best real estate groups. So they referred us, we did a meeting together, and then we kind of teamed up with them. So it was their relationship, our expertise, and together we've been kind of doing the deal. But it will work both ways. There are times that we'll see stuff internationally, and to help us diligence it or figure out, how quality are the folks and, how realistic is something, we'll tap into the knowledge of our, overseas-based offices.
Would you say that a significant amount of your international business comes from referral from your international offices, or is most of it from relationships that you've kind of built through the New York office and through Marty, like you mentioned?
At this moment, it's probably things that are straight up international, where it's an international company doing international business and nothing U.S. That's mostly coming from another office. Okay. If it's a component of U.S. and international mixed together, whether it's capital coming from one country, product from another, or company based somewhere but with U.S. assets, that's generally coming through our group.
Okay.
You answered my question.
All right. Someone else I have it?
Centro's another deal that we did. That was a restructuring deal. Stag was a single-tenant industrial group. Actually, a fairly fascinating story. These guys buy assets that have one tenant. They're in places that you would think are less than favorable locations. They get a higher yield because of that. And that is because they compete against local owners, operators of real estate that have less tolerance for the risk that if the tenant leaves, their building's completely vacant. What they've done is they've aggregated a portfolio of these kind of assets across the country and said, we no longer have a binary risk. If a tenant leaves one or two of our buildings, our portfolio is still 95% occupied. We can handle that risk, and therefore we can be a better buyer of each of those individual assets, aggregate them, and have better aggregate credit. And so that was a company that we had worked with for a few years to figure out what they should do to raise capital. Ultimately, the best way to raise capital for them was to go public, and so we took them public earlier this year. This over here is the first Mexican REIT based on some legislation that our group, Protego, based out of Mexico, was able to work with a very wealthy family out of Mexico that owned a lot of real estate. They were able to go to the municipalities, work on some legislation with the government and with the municipalities to get kind of REIT legislation passed, and then we helped take them public. And the rest of these are kind of follow-on offerings and IPOs that we worked on. And I'll get to that last deal as we go through some case studies. This is our group. This is Marty Chico, the guy I mentioned at the beginning of, I guess, the presentation. That was the vice chairman of global real estate. Greg Brooks is the managing director in our group. To me, that's our analyst, and we've got another analyst that's in our group as well. So we're just a group of 5, and we're lean, but we can use the other resources of the firm, the generalists, associates, and analysts when we get very busy and when we need more manpower on a deal. So while we're a dedicated group of 5, we very often are working with folks from other sides of the shop or generalists.
Maybe you could expand on Josh's role in the deal, being an analyst, because most people in here will be going as first-year analysts somewhere. So
sure. So maybe we'll do that in conjunction with a case study. But generally the analysts are doing a lot of kind of information gathering and preparation so that everybody can fully understand the situation, right? So they're the ones that are really kind of the backbone of the group, the analysts / the associates, and they're doing everything from modeling IRRs, looking at combinations of companies to understand at a high level what is it going to mean to company A or B if a merger was to happen, things of that nature, running IRRs on a deal to see what someone might purchase a particular portfolio out of the like. They're managing data rooms when we're running a deal on the sell side. So as you can imagine, there's a phenomenal amount of documents when you are selling a business or selling a portfolio of real estate, and someone's got to get all that information from a company into an organized and useful way on a website so that potential buyers can look at it and quickly come to a conclusion as to whether they do or don't like the company or the assets and how much they'd pay. Because the longer that takes, the higher probability there is a deal won't happen or something can change, or the frustration level, or the higher probability that somebody drops out of a deal because they just don't have the manpower to get through and organize stuff themselves. So it's critical what the analyst does in terms of the organization, the modeling, and the getting things prepared in that respect. And then it dabbles past that into the execution side. So, when we are fielding calls with questions about documents and analysis we've done on a process, Josh in our group will be the point person on a lot of the real fine detail, the stuff that gets really, really down into the weeds, because he'll be the most familiar with that stuff. As you move up kind of to myself and the other folks in the group, we're generally getting more involved with strategy and directing Josh as to what are the fine points that we need to know well. And he'll be the one that actually finds them out, figures them out, and then educates us on what's going on at the really, really granular level. So that's kind of how it works. Is there more you wanted to?
No, I was just going to say one of the interesting things about Evercore is that it's small enough that Josh, for instance, he's the go-to guy in the real estate group. So he literally gets to work with Rob and Marty directly sits right around the corner from them. He's always in their office, kind of talking with them and learning about the strategy. So I found that in my experience at Evercore too, just kind of being able to work with senior people very closely.
Yeah, no, I think that's true across the board. And while it's not his direct responsibility, I try to keep Josh, and we have another analyst, Nick. I try to keep them as involved as possible. So I've given them a lot of leeway in terms of, here's what I need you to do. Here's the time frame I need this kind of analysis or stuff done. But here are some other things that I'm doing that you're welcome to be on the call, at the meeting, with me, doing whatever, just not at the expense of getting everything else done. So manage your own time. I'll tell you everything going on. You choose, right? You tell me, if you want to be here till 5 in the morning to finish what I asked you, but because you'd like to be on a 3-hour conference call, go for it. I'm happy to have you involved, hear it, explain it to you, talk about it. So I give at least my analysts a lot of leeway in that respect, because I feel like it's helpful for them to learn, and that's the more exciting part of the job, right? The doing the analysis isn't as exciting as the analyzing the analysis and trying to figure out, what does it mean? What do I do with that? How useful is it? So you kind of get more well-rounded when you see that your analysis is used to do this. Then the next time you do it, it can be a little bit more tailored towards the usefulness.
On that note, can you touch on the mentorship program that you mentioned in the lunch session?
Sure, yeah. So Evercore has been really focused on how do you integrate everybody at the different kind of levels and make this more of one firm as just opposed to a bunch of industry groups and then kind of a hierarchy or whatever you want to call it within the industry groups. And so one of the things they do is kind of a mentorship type of program. We partner up usually a vice president or associate with every incoming analyst, and they're usually in a different group or something unrelated to what the analyst is doing, so that they can have informal meetings and talk about whatever they want to talk about. I don't like this going on, or how do I get to this spot, or I'm doing too much of this, and how do I get to do more of that? Those kinds of conversations can happen in a much more, private type of environment with there's no ramifications to it. It's not like you're going to the person you're working for and saying you're not happy about something. So in that respect, we do that for that. We also do it to kind of career coach and to help them through, just general questions and anything going on that they want to know about. So we do that with the analysts, and we do it with the associates as well. So this is one particularly interesting and incredibly complicated deal that we worked on this year. It's a Australian-based company that for about 4 or 5 years went on a huge buying spree of U.S. real estate assets, all shopping centers, all strip centers, well, mostly strip centers. And they did this at exactly the wrong time. They had peaked their buying through kind of 06 and 07, and then, as everybody knows, kind of the world collapsed, and particularly in real estate it collapsed. Centra was left with a ton of debt because they'd done all these transactions in a fairly leveraged way, and they also were syndicating. And by that I mean they were buying all these assets, and then their plan was to sell them to different funds they had set up. And in the middle of doing that, the world collapsed, and they were left holding a tremendous amount of assets with a lot of leverage, a lot of what was supposed to be short-term leverage that couldn't be refinanced out. So they went through a series of refinancings, restructurings, and ultimately they had a lot of revolting at the parent level. They had a lot of interim kind of debt holders that sat between the parent level and the property level that were left with loans that were maturing and no viable solution. And so we got hired to represent a group of banks that owned a bridge loan that was used to fund one of these acquisitions, and to figure out, what do we do, right? We've got a $1.7 billion loan, and it's on roughly $4.5 billion of assets, and we don't know what our loan's worth. We don't know what we have claim to exactly, because this company's so complicated. And we also don't know what the right strategy is. If they don't pay us back, do we want to buy the rest of the company? Do we want to just try to get out for as much as we can? What leverage do we have? What do we do? So we got hired to sit in the middle and figure that out, do all of the implied kind of valuation work, get them a flavor for what they do and don't own, what would be easy to get access to, what would take a longer time, and ultimately, did they need to buy the rest of the company because there was this management entity that was not part of what they owned. So they could have taken back their assets and then owned these assets and had no one to run them. So all these things kind of thrown into a mix. They said, what do we do? And we went through, analyzed the portfolio, analyzed where the management company sat, what would happen if you bought the whole thing, what's the likelihood you're going to get your money back and you don't need to do that. Went through all the scenarios with them. And luckily, Blackstone had a lot of extra cash burning a hole in their pocket, decided to buy the entire U.S. side of the operation, and paid off our lenders in whole. But this was like the quintessential way to work across groups. So we had the real estate group understood the real estate inside and out. We sat with Centro, went through all of their different, capital expenditure plans and understanding how much money was needed to run the business and how good or bad the assets were. And the restructuring group went through the entire entity chart, which was 90 pages long for this company, of where everything lived and what you had claim to and what you didn't and how it all worked. And between us, we were able to come up with a plan of what things were worth, what your claims were like, and then ultimately how that value flowed through to the lenders. And so it was a fascinating assignment, and it was a nice way to kind of work across groups at our firm. These are just some things that we did, and have they taken like an intro to real estate class or? Okay, so you guys will be familiar with some of these terms like cap rate and FFO, although you may not fully appreciate what they do and don't mean. But we went through a series of analysis to see what this portfolio was worth, because is it worth the same if I just own these assets as if I took these assets and then went public? Would there be a valuation gap? Is it better to do that? I don't know. So we looked at all those things, and then we said, you know what? Maybe people think the cash flows aren't ripe yet. These assets have been neglected. Maybe when I look at the cash flow, it's not the right number to really just put a multiple on or a cap rate on and get a value. So we looked at, okay, well, maybe we'll just look at a price per square foot to see what the bottom value could be for this stuff. There were appraisals done from the company. They did them, I think, semi-annually for a third of the portfolio. So over a rolling year, they had a new appraisal for every asset. And then we ultimately took the cash flows and did a standard DCF. And we put these all on what you call the football chart, where you look at all the different types of metrics, see kind of where they overlap, and you kind of come to a logical range of where the valuation might lie. So all that stuff was kind of standard and what we'll do on a lot of deals, but this one in particular.
Yeah, I mentioned they were leveraged up at around a little less than $2 billion on about $5 billion in assets.
This was the most junior debt.
Okay, so the total enterprise value that you were able to get them was a little over $9 billion?
That was for all of the U.S. assets. This was on just $4.5 billion of the U.S. assets.
Okay. Was there a control period involved, or is that a discount than what the actual book value was for the company?
So hard to say. So hard. Just like I couldn't even tell you what the cap rate was. There are so many different cash flows, and depending on which metric you wanted to use here, I could have given you a range of answers about this wide. So it's really, really hard to say. The numbers that were quoted as to what they bought this at were way more lofty in terms of cap rate, or the yield was a lot higher than where we saw it to be. So Blackstone will claim they got a fantastic deal. When we look at it, we say they paid a lot of money for it, and probably somewhere in the middle is the right answer.
So for this deal in particular, you go through all these different valuation approaches, and you've got 6 of them up there, and what you're saying is that you basically came up with 6 polarly different values, right? So how do you
Not polarly different. They overlapped.
Okay, so how do you kind of just like narrow it into one to finally say to one, your client, okay, this is what we think it's worth, and then 2, to Blackstone, who you ultimately sold it to, well, this is reasonable. What do you think about buying it at this rate?
So let me break that into 2. The second part, we weren't selling the portfolio. We were just advising the lenders on what they should do when a plan came to them.
Okay.
So Blackstone went to Centro, the company. We were representing actually the lenders at a subsidiary of Centro.
Okay.
So we didn't have any control over necessarily who bought it. We just had control over whether or not the lenders got paid back in whole on a purchase, and if they didn't, what do they do?
Okay.
because they had a right not to get rid of the assets if they weren't being made whole.
Just on a valuation in this case.
By the way, it's an implied valuation. We're not allowed to say we were valuing it. We were implied valuation.
Because you're revising a mezzanine loan, so then you would pay a lot of attention, it seems to me, to thinking about what the lowest estimates could possibly be, right? If you had estimates that were way above there was 2 times as much money after you cleared out all the senior debt. There was the asset valuation came in twice what below, and then you sort of worry about that. So one where they come in close to the amount of debt that total amount of debt is due.
Correct, yeah.
That's a very different kind of valuation exercise, isn't it, potentially? Sort of worst case scenario,
Yeah, you always want to look at your kind of your worst case, your base, and your best case, right? So that way you can kind of be prepared for any of the inevitable, hopefully. And absolutely, yeah. If any part of the analysis was above a par payback for the lenders, great, worth doing a sale as long as these guys didn't want to try to roll into the deal for some reason.
Right.
If it wasn't a full payback,
was that ever contemplated to roll into the equity position?
We certainly looked at not with a new buyer, but we certainly looked at if there was not going to be a whole payback. What do you do, and how long would we want to hold it, and would we want to buy the other half of the company that we didn't have claims in? So we did look at that.
And so what did there was a lot of debt in different places, but the Blackstone bid was how much more than the total debt outstanding?
I think it was on this particular portfolio, I think it was about $1.25 billion maybe over the debt that was attributed to this portfolio, but it gets to the nth level more complicated because then at the parent company there's more debt, and there wasn't enough from the proceeds to pay back all the debt at the parent company, but that had nothing to do with the portfolio, and there was a lot of tension between different individuals in different parts of the capital stack and who had secured versus unsecured claims.
But you were ahead of a lot of people, suffice it to say.
Yes. Yeah, because we had direct claim to these assets after the property mortgages and then some of the unsecured debt from when New Plan Excel, who was the company that these guys bought at the peak of the market, from when they went private by buying them, they still have this unsecured debt out there.
And so some of these other debt that was junior to you, they could veto the transaction, right? Or maybe they had some coverage violation. Where did they have to raise their hand at opportunity?
Yeah, I mean, they could because their debt was due so Centro is a publicly traded company in Australia. And there was debt issued by Centro, the public company. This was a subsidiary of it in the U.S., and this was only one half of the subsidiary.
Right.
And so there was debt above kind of every level that was, yes, junior, and they all had different rights as to whether they would or would not accept the transaction. And it was all based on, well, where the proceeds go. They pay us back, pay someone else back. So yeah, they all had kind of their various rights. But they also had a way, well, what's the alternative? If this deal doesn't happen, what happens? So it was a lot of game theory on this particular transaction. This is the Mexican REIT I was talking about. Oh, go ahead.
How difficult is it when you're dealing with such a large portfolio? So I'm assuming you have properties in markets across the United States, and you're looking at it from this kind of cash flow with vacancies. Every market tends to be different as far as 9% might be good in this market, 15 good in another, 3 might be good in another. How do you educate yourself about each one of these markets to be able to do your sensitivities?
There's a lot of information out there that we have access to from subscription and from free sources as well, so we can get a good flavor for what are the kind of the cap rates of comparable transactions, what are the vacancy rates, what's the price per square foot stuff is traded at. You can zone in on a reasonable range in most markets. Now, could I tell you, I have good enough information to know what a suburban office building in Ocala is? Probably not, but when you start getting to slightly bigger markets than that, there's much better information. So there's plenty of sources, but some of it has to be kind of arranged, right? Otherwise, you could spend your entire life trying to figure this stuff out, even if you owned it and it was only one asset. So this was an interesting deal as well. This was us, the real estate group at Evercore in the U.S., working with Protego, who I think Evercore owns 80% and they're based out of Mexico. And they had a client who was one of the largest owners of real estate in Mexico. Mexico did not have a they did not have a really public market as we know it for real estate. They did not have a good way for pension funds and institutions to invest into real estate. And so our group down there worked with not only the highest level government officials, but also the local municipalities to get some legislation passed that would allow REITs that looked fairly similar to the way the U.S. REITs look. And once they did that, we then went through the process of taking this company, Fibra Uno, which was a portion of this wealthy family's assets, through the public market process. They were fantastic assets. They're across some of the more well-populated parts of Mexico, including Mexico City. And the real question was, what's the appetite going to be like overseas? Because the Mexican market's fairly limited in terms of who can invest in this, so we have to kind of get some international interest here. How do we do that? That's where they brought in our group, the Evercore Real Estate Group. And so we went out to the largest owners of public shares of real estate, who we know very well, and started talking to them about what makes you interested in Mexico. What makes you want to do this, instead of doing Brazil, which everybody's talking about. And, what are the characteristics here that are going to scare you away, or what makes it, kind of investment that you have to do. And it kind of came back that it was fairly yield driven, and there was a little bit of push and pull between where the client wanted to go public at what particular yield they wanted to sell at versus where the U.S. market would have a significant amount of demand. And so that debate went on for a while. This ended up being a deal that went a lot more in Mexico than we had originally anticipated. I think it was something like 80% of it was sold within Mexico. And our debate all along, which anyone should be thinking about when they do an IPO and they don't sell their stake on the IPO, so I go public, but I'm only going public to raise additional capital, not to pay myself down, is how much does it matter? How much does it matter what the prices I sell at? If I have to sell at $19 a share, but I think it's worth 21, and I think next year, the stock may go up to 21, did it really matter that I sold at 19 or not, right? These are the kinds of things you have to think about, and we were trying to explain that to the family that was going public, because they were in this for the long haul. They weren't looking to just monetize and sell out. They wanted to expand their empire through this vehicle. And where the public investors were willing to invest, again, was fairly different from where these guys wanted to, the yield they wanted to sell at. And so that went back and forth for quite a while. We finally came to a price that was agreed upon between investors and the sponsor. It became a much smaller deal. That's how we bridged the gap. They decided it would be fewer of the assets involved, and because it was so well received, the stock has actually performed pretty phenomenally. So you can see the yellow line is kind of how this stock has performed versus one of the major Mexican indices, and I'll show you later kind of what the U.S. IPO market has looked like this year, and it's been terrible. And these guys are up they went public at $19.50 in March of this year, and they're now trading at $23. So stark contrast between kind of where the U.S. market is and where these guys went, because they ended up going at a relatively attractive price and garnered some interest and got some trading volume.
How leveraged was the asset portfolio?
Almost zero on the public.
So what's just the obvious question is why, if they weren't completely satisfied with the price they could get, and they were, I have it right, and then also the second part was that this was part of a capital raise. Did the conversation come up to try to borrow against it?
Yeah, it did, and they looked at them as quite separate types of options. They wanted to have a public vehicle because they believe that the growth that can happen and the access to capital in the public vehicle will greatly exceed anything they can do on the private side by just levering. And they could always lever this too, right? So they could raise the equity capital and lever it. So you kind of
Liberate public debt more easily and things like that if they were public.
would open that option, right? So you'd have now public debt as well as just mortgage debt. And so they really wanted a public entity. And that's what it really came down to. And it's turned out to have worked out well. And the stage 2 of the transaction was exactly what you said, was to then raise debt to then further acquire assets. And then as the stock price rose, if it did, then they could just raise more capital and buy stuff. And it was
Not only precipitation the asset and the appreciation, just if you want technical aspect as well.
You got it. So that was kind of the whole theory here.
You said that they were a bit reluctant to sell as much of the business as they wanted to originally because they could only get $19 per share.
Mm-hmm.
And what you were basically advising them was, yeah, you can't get as much now, but we feel like the stock's going to appreciate and you'll make it back up anyway. Mm-hmm. Since they've seen that, have you either contacted them or have they gotten back to you saying, yeah, Evercore was right, maybe we should sell a little bit more ownership in the company like we originally intended to?
So our Mexican counterparts, Protego, have been in contact with them. We haven't had that conversation.
Okay.
So I don't know when they're, they did a few more assets into the entity,
Mm-hmm.
but I don't know when they're going to look at it and say, you know what, you're right, we're wrong. And I don't even think it matters if they agree to that or not, as long as this entity grows. And by the way, the reason why they wanted to go public too is that there are a few others thinking about doing this, and there is some advantage to being the first mover. And so at some point you have to say, well, does that advantage outweigh the potential increase in stock price we could get by waiting a year maybe? See what happens.
So there's an institutional investor demand for real estate equity, then you're obviously providing all of it at that point in time, right?
They're the only option right now. The only option. We're hoping there's more options to follow. Another deal that's worth talking about. Oh, go ahead. Sure.
You had mentioned the advantage of being the first mover, but would one of the disadvantages be the fact that they publicly disclose their financial statements, so competitors might get a better look at their operations previously to then sales exposing their operations?
Sure, if you fail. Absolutely. If you succeed, you always have to give that, right? Once you're public, and there is transparency. But you're right. I mean, that's always one of the risks of going public and failing, is that you've now showed your hand a little bit, and people. But I will tell you that and what you realize as you do banking longer and longer is that information does get stale, and so just because I showed you all of my tenants and what all my assets look like now, next year, that may not be so relevant to you, and more so in certain asset classes than others. Right? The longer the term of the lease, the more it's relevant. But if I own a bunch of apartment buildings, does it really matter who my tenants were last year? So there are certain.
Real estate it's a pretty unique animal in that sense that
Sure.
the transparency isn't as important as maybe a fast-growing tech company exposing its unique technology to the world in that sense.
Yeah, perhaps. Although they'll have some of that patented, so they'll be protected in their own way. But yeah, absolutely. There's different things you have to worry about with a real estate company going public versus another industry. Absolutely. So UDR, this transaction, I put it up here because most people, when I tell them what I do and they don't have an intimate knowledge of Wall Street or of what banking is, their first inclination is to say, oh, you're a broker, right? You sell buildings. And it's, well, no, that's not exactly what I do. And so I thought this transaction might kind of illustrate a little bit as to how a real estate banker is different than just than a real estate broker, and what we both do kind of differently and better maybe than each other. This transaction was UDR, public company. They'd always, and they're in the multifamily space, so they own apartments across the country, and they were always trading poorly compared to their peers. And you guys, anyone that's going to go into banking or anything related to it will get very comfortable with the whole concept of comparing one company to another based on 700 different types of comparable analysis, multiples, yields, and all that stuff. But the one or two that everyone look at in real estate that are most relevant, UDR was lagging, and they were trying to figure out, well, what do we do? How do we get out of this rut to get our stock price up? You know, what's going on? And we were brought in to help them think that through. And we came to the conclusion that people are viewing your assets as lower quality than they actually are. So maybe we take a big chunk of your portfolio that's not in the markets that you want to be in, and we sell that. And then we take that capital and deploy it into markets you do want to be in that everyone likes, and perhaps that'll get rid of the perception that you're in these lower growth, less desirable markets. So we went through that concept and came up with a portfolio, and ultimately were hired to then sell that portfolio. And this is where I want to kind of stop the tape for a second. This is the part where we compete directly with a traditional real estate broker, right? A traditional real estate broker on the capital market side is doing exactly that. They're taking assets or a portfolio, trying to find as many potential buyers as possible, running a process and trying to sell at a maximum price that will close. And so in this respect, we were doing exactly that. What we did that the traditional broker won't do was this initial part, the exploring with the company, what do you do? Why do you do it? And then when we're going to do it, how are we going to do it? And what are we going to tell the public? How do we disclose this properly? How do we make sure it comes across the right way? And how do we make sure that it does increase kind of the perception amongst all the investors in your stock, or the ones that are not in your stock that you want to get in there?
Does perception play a bigger role in real estate than other investments, or is it
probably the same? Probably the same, but the more you follow stocks, the more you'll realize that part of it's irrational, part of it is grounded in fundamentals. But either way, perception matters. And this was factual. I mean, this was the lower productive, the stuff in less desirable markets with lower revenue per apartment type of assets. So it was factual that we were improving certain metrics of the company by doing this transaction. That was just factual. So hard to ignore that on a perception basis. So we ran this process, and lo and behold, during the process, the financial market starts to crumble. This is kind of end of 07, beginning of 08. Lenders are starting to say, I don't know that I want to lend anymore. Maybe I'll still lend for apartments. Fannie Mae, Freddie Mac were still in business, but they were starting to get a little bit weary. They were slowly closing their doors. Things had to be underwritten a little bit more stringently. And so we said, well, we don't want that to happen. We don't want to get to a deal here, and then the buyer says, oh, I couldn't get financing, I'm out. I'm going to have a financing contingency in my contract that allows me to get out if I can't get the debt. So what we did here was we went to the agencies ourselves and said, here's the portfolio, here's kind of a price that we think it might go at, get some loan packages together for us. Show us the matrix of, at different leverage levels, where you will loan on this. And I don't want it being theoretical. I want this to be factual. I'm going to give you all the diligence documents. I want you to go through your diligence. We'll pay for it. We'll pay all those costs. So when the buyers come in and they give me a number, I can tell them that, your contract cannot be contingent on financing because I have financing for you. And so that was something creative we did that actually allowed this transaction to close, because surely enough, the market got worse, and this thing closed kind of, I think it was March or April of 2008, when most people couldn't get loans anymore. It was one of the last big deals. And as a matter of fact, this was before we had sold our business to Evercore. And for 2008 and I think 2009, MJC Associates, which is where we were before we sold to Evercore, was the largest broker for multifamily. We're three guys. So this was like the end of the window of transactions until probably the end of 2009, beginning of 2010. And so to get back to the perception, here's what happened after we sold this. So the blue line is UDR. It's the company, and you can see kind of before this transaction was brought to the market, they were trading at a significant discount to the rest of the apartment REITs, which is the orange line. 12 multiple versus an 18. And you can see on the timeline here how we announced the transaction here. And amazingly, after this thing closed, the spread completely evaporated. And these guys started trading right in the middle of the pack instead of at the bottom 1/3 of their industry. Now, is that all because of this transaction? I'd love to take credit and say yes, and I can lead you to believe that. You'll never know. You'll never know because it's a public market and there's all sorts of variables you can never account for. But you know, it's fairly compelling when you look at exactly the timing and how this all worked. And by the way, how bad the market felt kind of starting here and through this kind of this whole area. So. So it was sold at a cap rate that was a little sixes, so maybe like a 14, 13 kind of multiple maybe.
So it truly was, I mean, so it wasn't like you were raising the multiple by simply selling.
No, so
I should touch on that.
I should touch on that. So the key here was not only the sale of these assets, but it was, all right, so you have all this money, that's terrible, right? When I invest in a REIT, what do I want? I want income. I want you to keep producing income, and I want you to keep producing more income. Selling assets, terrible, bad strategy. What are you doing with that money? I don't want you just to give it back to me today. I want you to make more money off it. Why invest in a REIT? It's tax advantage structure, and it's meant to pay you dividends. So part of this, when we announced the transaction, was managing, telling the public, what are you going to do with that?
Right.
And so we came up with a few things. One of them was we talked about some of the acquisitions and the markets we were going to 1031 or tax effectively trade the cash to buy these new assets. But we also did this. So UDR put up $200 million of mezzanine financing, A, to help the transaction get done and to help this thing lever a little more, but B, it was a use of proceeds. And it was an accretive use of proceeds because the rate at which the debt was given to the buyer was accretive and was at a better yield than where they sold the assets. So between the purchases, and then we had to do a special dividend, between all that, we actually were able to show a very productive use of the proceeds and a productive increase in some of the relevant metrics of an apartment company. But you have to do all that, especially in the real estate world.
With the reinvestment of the proceeds through the 1031s, how involved were you guys with picking the properties that were going to be reinvested in? Did UDR come to you and say, here's the properties we want to move into? Or was it you guys kind of worked together to develop a good use of the funds?
So, no, we didn't pick the assets. We really didn't approve of the it wasn't for our right to approve or disapprove of them. That's really their business. That's what they're good at, is picking assets, managing them, improving them, running them, getting good yield out of them. What we did do was said, if we're going to do this transaction, have you targeted acquisitions? Are they more than just a thought? Are you far along in some negotiations? Are you bidding on certain stuff? Like, how long is it going to take you to use this capital? That's the kind of stuff we focused on. What's the yield at which you're going to buy it at? What are the markets you're going to buy it in? Those kinds of things we focused on, but the actual asset and the particulars of the asset, we really left it to them because that's their job. That they are the experts there. Unfortunately, in our world, when we're working on a deal, we can't really talk about it much, confidentiality reasons. But I figured I'd at least kind of give you a little bit of verbiage just so you get a flavor for the kind of stuff right now that my group's working on. And so just quickly, we talked about Westfield a little bit. We're advising a medical office owner, which is a real estate class most people don't think about, and it's kind of unique. Because while it's office, it's also smaller spaces, and the tenants are generally doctors and x-ray technicians and the like. And they're generally valued more if they're nearer to hospitals or denser areas than if not. So we're helping them kind of create a platform and raise some capital. We're working with the company I told you about before, doing some capital raising for Brazilian shopping centers. The next one is we've also started to dabble in some of the private equity fund world to help restructure some of these funds. So we're working with another group at our firm on doing some of these kinds of assignments. One large one in particular, there's a multifamily company that is trying to grow, and so they're looking at a couple different M&A deals, and so they've hired us to evaluate which one makes sense, how do we do it, how do we approach them.
Fundamentally, what are some of like the biggest differences that you see in the structure of transactions
In terms of now versus a few years ago, or versus us in different groups?
Yeah. I mean, just like given the current market condition, are you working on other things that you may not work on as frequently in the past, that kind of thing?
Yeah, I mean, look, there's been, we'll get there. I actually have a slide on this that we'll talk about, but there's been kind of a dearth of M&A activity over the past few years. So less of our business has been M&A versus kind of restructuring, strategic alternatives, and thoughts of M&A as opposed to the actual M&A happening. Spin-offs, asset sales. It's been a lot more of that kind of work than it has been M&A, which has traditionally been our business. But we are now advising quite a few companies, or at least helping them look at different mergers and acquisitions type of deals.
Is that a function of the market, or is that more so the companies just don't need to be?
It's the market. Part of it's the the debt market. Part of it is the debt market's a large part of it, right? A lot of M&A has a levering component to it, whether it's an LBO kind of deal, or whether it's one company buying another and saying, well, all right, so I can use some stock maybe if they'll take it, but I don't have enough cash to do the deal, so what do I do? To either partner with someone or to borrow. So that's kind of style with it. While debt seems really cheap and 10-year treasuries push 2%, it still doesn't mean it's easy to get that kind of loan, right? If you can get a loan, very attractive, but not that easy, and especially not this past month or so with the crazy amount of volatility it's been in the world.
How have your clients responded to the recent market conditions? Basically, are deals being shelved, or are your clients waiting for the markets to be calmer?
Yes, on both of those. But there are some that are still pushing through, and there definitely are some of our clients that are on the buy side that are saying, find us some. We want to buy. So we're in the challenging spot of trying to say, well, we know these kinds of things that are product that want to sell. We know this kind of capital that wants to buy stuff, in these different ranges. How do we figure out that match between them? Because they may have different return hurdles or expectations, or different products they'll buy versus what we know can be sold. And so we're kind of in that mixing and matching stage right now, trying to figure it out. But we're working on a few live deals that I feel relatively confident will happen. So deals will happen. It's just not going to be some kind of immense volume of deals going on yet until the capital markets settle down. And part of this is the M&A, because public to public stocks, well, everyone thinks their stock's undervalued, so they don't want to do a transaction. And part of it is the debt markets.
You mentioned in the very beginning that your goal as a company to increase revenue from your fee-based business. Is the whole industry also moving that direction, or are you behind, or are you guys trying to catch up, or are you guys leaders in that area?
I don't think the whole industry is trying to do that, but there's definitely a premium at the moment in the public markets for recurring revenue, right? And advisory revenue is not quite as recurring, therefore the multiple is lower. And you're always trying to strive to get your multiple on your whatever metric you're using as high as possible, right? Because then the same amount of income garners a higher price. And so, it's a little bit of kind of what you're trying to do with your business. Do you want the lumpiness? Are people paying you for the lumpiness? Or is it better to have recurring cash flow that you can get some kind of constant multiple on it? Our company has chosen to smooth out some of the lumpiness. So we're still growing our M&A practice. We're just trying to grow our investment management practice a little faster than our M&A practice is growing. And that's kind of been the strategy.
How are we doing on time? Perfect. All right. We're going to just cover the markets after this.
Yeah.
I'll do that.
I know this isn't exactly your area, but most of us here have or are currently taking a corporate financial modeling class in which we'll walk through step by step what happens during a merger. Can you explain what Evercore's role has been in the merger between AT&T and T-Mobile, and what is currently happening now that they've hit a major roadblock?
Unfortunately, I can't talk about that. I can talk about kind of what we do with mergers, but that's a live deal that I'm not kind of privy to talk about.
Okay. Sorry.
In a few months, maybe we can talk about that. Okay. I don't want to avoid the question altogether, but at the moment, it's not appropriate.
How about just in a general situation, what your role would be?
So it'll range from anything from targeting acquirers to running a process to either on the sell side or representing a buyer. So that's the kind of different sides you can take of the deal. But during the merger, it's kind of everything from the financial analysis of does this make sense to the company that we're representing. So in terms of the buyer, is it accretive? If it's not, how does it get accretive? What are the ways that you can improve the two companies together? Does it make sense for them to be together? What are the hurdles that you're going to have to reach, whether they're regulatory or financial, are there covenants that'll be tripped, all that kind of stuff. But I will tell you that when you're doing an M&A deal, the lawyer is critical because you rely a lot on their read of corporate documents, different things that are in the loan documents as well. And so there's a very symbiotic relationship between what the law firms do and then what the banks do. So a lot of it is first them telling you, okay, you can and can't do this stuff, and it's us saying, well, here's maybe a creative way we can get a deal done. Does that work within the legal documents? And then coming back and saying yes or no, it does or doesn't work. And it comes to everything between maybe we think that you can reduce overhead by you can get rid of half the staff, but then when you go through the documents, you realize, well, the severance is outrageous, and that's not going to work. So it's looking at all of those things and seeing if it financially makes sense, if it can actually be done, and then kind of what are the ways to do it? How do you finance the merger? Whether it's through stock, whether it's through loans, cash, a partner, all those kinds of things.
With the growth of data center activities and the trend moving towards cloud computing requiring large amounts of resources without consider real estate because they are going to be assets on large amounts of property. Have you or do you anticipate in the future few years your real estate group actually handling those, or is that going to become a function of the technology group in Evercore?
Yes, to both of those. So we worked on CoreSite, which was an IPO less than 12 months ago. Exactly that. We worked together with our telecom group to take that company public. We represented Carlyle, who was a large investor in that company pre-IPO and actually post-IPO. So yeah, those kinds of deals, we can do them by ourselves. The telecom group can probably do them by themselves as well, but together it's way more powerful because then we have the knowledge of both sides of the business. And we also have one or two restructuring professionals that have a focus on that exact area. So we've generally teamed up, actually, the three of us to do it, and it's been quite powerful. But I could see that happening. I mean, a lot of private equity shops are talking about maybe we have a sidecar, for just the data center stuff. It worked for GI Partners, a company based out of San Francisco. It was one of their best deals ever, and Carlisle's done well on CoreSite, and so a lot of attention right now is on that space.
I guess since we're on the technology topic, has Evercore ever considered actually starting a VC fund?
So we did. We had not a VC fund, but we had a private equity kind of wing to us, and it was kind of the question asked earlier over here as to why hasn't that grown. And to be quite honest, it wasn't that successful for us running our own private equity shop, so we kind of stopped the growth there for a while. So I don't imagine we will have a VC fund anytime soon. I just don't see that. We will always be apprised of what's going on. We will always have our finger on the pulse of where loans can and can't get done. but it really depends on the situation as to whether or not we are very active in getting the loan or working through the approval process and the like. More often than not, we are not, especially on like a portfolio sale. It'd generally be the buyer that does that, and they have their own relationships and they want to do it themselves. But when it comes down to an M&A deal or any other kind of capital market transaction, yeah, we're fairly involved. I mean, I've got contacts at most of the banks that I talk to regularly about what's going on, what can get done, what doesn't, what do they have appetite for, because that really governs the type of stuff I can recommend to a client. If I don't know what a lender will and will not do, I don't know how I can possibly advise my client as to how they can finance something or how they can structure it.
Sometimes you know even if you're not actually helping them get
Oh, yeah.
follow information.
Oh, you have to. Yeah, you have to be up on that. Absolutely. You have to know where the public markets are, what the private guys want to do, and where the lenders are. Yeah, absolutely. So maybe we'll move for 1 second. I think we've covered a lot of this, but the main reason why real estate bankers are different than the rest of investment bankers has to do with the product type and how kind of granular it is and how much we have to know about how the assets are valued, and how much we play between corporate finance but also the knowledge of the product and how tangible it is. And so because of that, and because real estate is, mostly held in the hands of private investors, there's a totally different lingo, different words, different things. It all ends up being the same thing as the rest of the public markets, but there's just different language we have to kind of get used to. But what you'll notice is that my group in particular, while we're investment banking all day, every day, out of the 5 of us, there's only one of us that's actually been a career investment banker, and that's Marty, who runs our group. The rest of us, one guy was a hedge fund manager, and you'd say, well, why is that helpful for banking, right? But in our space, he knows every one of the major investors in public real estate. He also has very strong relationships with a lot of the CEOs and CFOs because he was the major investor in all these companies at one point. So it's an interesting way that when we do a deal, my background was in acquisitions and dispositions in real estate, and I can look at it from the real estate perspective. Greg, who's the MD in our group, he can look at it from, no one's going to want to buy that, or this CEO is just not ready to do that kind of stuff. And Marty has seen every kind of transaction, so he can opine upon what type of transaction could or couldn't happen, or what we have to look for to see if a transaction's viable. And then our analysts, one of them was in development, and the other one was in property management. So it's an interesting group, and when we have debates, they're fairly lively, and it's all of us looking at things from different angles, and we come to some pretty interesting and unique kind of solutions because of that. And then our world is really small. Real estate is smaller than you think, and because of that, it's important for us to know every single player, and we do. We know, like I said, the buyers, the sellers, the CEOs, the hedge fund guys, the private equity shops, because you have to, because everyone's always involved in every deal you look at. I don't want to bore you with this stuff of how you get to FFO and AFFO. But this will put in perspective how small real estate is actually in the public hands. When you look at the total equity market cap of public real estate, $461 billion. When you look at the total market cap of Google, AT&T, and GE, it's the same size. Right? That is the same size as the entire public real estate market. It's it's become very correlated. The public market has become very correlated to the rest of the stock market, which was part of the goal of having real estate public, but it still is not. It's not a huge part of the public markets. This gives you a flavor for kind of how the capital raising has happened over the last few years, actually since 1991. But what's particularly interesting is what happened right around here, which, as everyone knows, was a terrible time in 2009. But yet, there was $33 billion of issuance, and the result of that was a lot of pain in the public real estate markets. There were some companies that had to issue 100% of their float just to stay alive and to pay down their debt. But the nice thing was they could issue 100% of their float and pay down their debt. So the public market actually kind of kept alive a lot of companies that in the hands of only private investors may have actually gone under and been handed back to the banks. So there's a...
Elaborate on that
Sure.
a little bit, because I own some, not very much obviously, but real estate preferred stock.
Mm-hmm.
So I noticed this was happening, and I was just amazed, incredibly pleased at how well, right? So all these real estate firms were very leveraged, and I thought we were about to get our head handed to it, but they recapitalized in a way that was very beneficial to people ahead of them in the capital structure.
Mm-hmm.
There was this huge equity raise there, right?
Yeah.
And I don't know of any other industry that's done that. And I can guess why, but I'd let you hear why. Your guess.
So what happened here is when we were talking about before about Greg, who's in my group, and how it's important to know who the major owners of the public real estate stocks are. Well, what you'll find is there are a handful of them that own a lot of these stocks and are major shareholders. And so some of the biggest ones got together and said, you know what? I have a solution for these 5 or 6 companies as to how they can stay alive. They have to issue this amount of stock, and you know what? We'll backstop it. We'll buy whatever, X% of that. And then once we show that we're going to be supportive of that, a lot of the other buyers will buy as well, and it will allow them to issue 100% of their float, 20% of the float, whatever the number was. But what happened was it was the bigger companies first, the Simon Property Groups of the world, that went first. Because Cohen and Steers, Morgan Stanley, APG, all the bigger investors went over to them and said, here's the deal. Here's what you need to do right now.
And presumably you mentioned a couple times the desire to stay alive was a feeling that real estate was artificially depressed, and so you wanted to be standing to have a balance sheet to buy when other people failed to do this.
This 08 and 09 was purely defensive. As you kind of came into 2010, it was, for the smaller guys, it was still defensive. For the bigger guys, it was completely offensive because their stocks had risen, 40, 50, 60% from where they had issued the prior time, and now they were ready to issue capital and do things accretively. So there was kind of two waves within there. The first one was, let's stay alive and pay off our debts now and show that we can stand this. And then the second one was, let's go attack. And you've seen a big dispersion between the performance of the larger public REITs and the smaller ones because of that.
But nobody ever wanted to recapitalize to make the bondholders participate in some of this downside. They weren't distressed enough to do that kind of thing.
Well, I mean, some of them got bought back. There was a lot of companies that bought back unsecured debt, at cents on the dollar. No, below. During this time period, too, if they were able to, they were prepaying their debt at 50, 60, 70 cents on the dollar.
That makes much more sense, I think.
Absolutely. Yeah, no, everyone shared the pain here, even the bankers. And this will just give you a flavor of kind of where that $460 billion sits, and you can see there's a lot of it in the retail space. Nothing much more to talk about here, but this is what we were just talking about in terms of the larger companies that were able to recapitalize first, and you can see how much of a stark difference there is between the top 5 or 6 companies versus some of these guys that are in the small cap REIT space. A company like Kite that's got a $280 million market cap versus Simon at $35 billion. So there's a big dispersion between some of these companies that are out there. And this kind of walks through just the M&A activity. I don't know if there's anything overly exciting to talk about. Other than 2009, not a single M&A deal happened in real estate. Not one. We talked about this a little bit, but this is how we look at the world a little bit in terms of how do you decide if one piece of real estate's worth more than another. And some of the things that we look at are how long the leases are, what else can you do with the assets. And for STAG, who we talked about earlier, the single tenant industrial group that I told you, can aggregate these assets across the country and not look at risk as binary between tenant is and is not in the space versus an individual that tries to buy that asset and owns that asset only. Alternate use is another another big thing to think about, because if I can buy an asset and the tenant blows out of the space, but I say, you know what, I can knock it down and create condos out of it, or I can put a hotel up there, I'm not as worried about the tenant moving out, as opposed to if there is no other use and the tenant moves out, I got a problem. I have to find another tenant, otherwise I'm in trouble. I've got zero value. So, and then we look at stuff which we just talked about a little bit before, which is, fee streams, in terms of, how recurring is revenue versus stuff that's lumpy and stuff that you can't really value as being there every year for a long period of time. And then we also look at kind of what the different constituents are doing. So we know when we have a certain product that we're trying to sell, or a certain company that we're trying to sell, who do we go to, right? We have to keep our finger on the pulse of who's going to buy best quality stuff. Well, it's not going to be the opportunity funds that need 20% returns because they can't afford to do that. It's going to be more of the pension funds. And when I have something that's a little bit more hairy, like Stag, or like one of these companies that's a little bit off the reservation, or maybe a data center, then I might be looking at more of the opportunity funds that will take a chance, but they need to get a little bit better pricing to do so. And then this kind of speaks to the same, the bottom chart kind of speaks to the same, crash in the market we talked about, and this very painful time here where there was that huge issuance, which you saw on the other sheet. If you look at it, look how low stocks were compared to their high, and this is where all the issuance was going on. This is where everybody was issuing stock. So it was a really, really crazy, painful time, but they still were able to do it. And up top talks to, I forget, we had mentioned earlier about how bad the IPO market was and has been this year versus how our Mexican REIT traded. And it's pretty compelling to vote against doing an IPO this year when you look at this. These are all of the real estate IPOs, and there is two of them that actually are in positive territory. So it's a tough market, very tough market to do this right now. And then if anybody wants to talk about any of this, I've got just comp tables up there so you guys can get a flavor for the different metrics we look at and how the different industries are valued. And you'll notice that there are different multiples based on the sector. There are different dividend yields. And then there are different implied cap rates, which is kind of how we look at how real estate's valued. That went public this year. So it's a little bit of all that, but it's also the market at the moment. And when I say the market, I mean the institutional investors that are going to buy this, because you can't always. You have a higher likelihood of getting an IPO done if you're willing to sell it to whoever will buy it, right? And whoever will buy it will be either institutional investors or retail investors. And retail investors are folks like all of us that have our money with whatever broker we have with, and they get an opportunity when there's an IPO to sell it to their clients, right? There's a lot of that demand, but the problem is that a lot of that demand, between that and some of the hedge funds and the like, is not sticky money. And so the more of that you have to access, the quicker that those stocks are going to turn over, and generally that's going to create kind of a downward pressure on price. So to get back to the question now of why is this happening, the institutional investors have become really stringent at the moment as to what they will and will not invest in. And they've said, you know what, if you don't have a manager that's already been public before and great assets and a compelling growth story and a checklist of governance items and the like, all the things that you should always have been thinking about, you can't even go public right now. You can't even think about it. And if you check those boxes, even some people just say, you know what, I'm just not interested in industrial today. I only have a mandate to invest in multifamily. So the universe is kind of narrowed a little bit as to who you can sell this stuff to at the moment and the requirements under which people will actually buy them. And on top of it, the market's been terrible lately, so that doesn't help every stock. So it's kind of a combination of all those things. I think that's kind of the end of the presentation, but I'm happy to chat if we have time to about anything else. Great.
Thank you very much.
Yeah.